Hi there. In this video, we'll explain corporation tax loss reliefs and carry-forward rules for UK companies.
A tough trading year creates a deficit, but these losses can be utilized to generate cash refunds or offset future tax liabilities. In 2026, the UK corporation tax main rate is 25%, while the small profits rate is 19%. With these rates applied to every pound of gain, optimizing loss relief is a high-stakes priority. HMRC's framework for these claims is divided into three pillars: securing past refunds, protecting future profits, and navigating specific sector restrictions. Successfully navigating a difficult period depends on both the recovery of sales and the reclamation of capital via the tax code. Take the example of an IT contractor. In 2025, the business posted a £100,000 profit and paid the associated tax. In 2026, they suffer a £20,000 trading loss. Under the carryback rule, a £20,000 loss is applied backward to the preceding 12 months, triggering a tax refund. This isn't automatic. On the CT 600 return, you must tick box 45 to signal an earlier claim, or the refund will not be processed. For businesses facing a sudden downturn, the retroactive carryback is the most direct route to restoring liquidity to the balance sheet. The rules change significantly for a property investor. If a buy-to-let portfolio incurs a £15,000 loss due to major structural repairs, the options for relief are more narrow. Unlike trading losses, property losses cannot be carried back to previous years. There is no mechanism to claim a cash refund for tax paid in the past. Instead, these losses are subject to a mandatory carry forward. They roll over to offset only the property income generated in subsequent accounting periods. One high-value exception exists for pre-2020 non-resident companies with income tax property losses. These legacy losses bypass modern deduction caps, providing a valuable offset against future profits. Because the tax code delays this relief, property investors must maintain a longer-term strategic horizon for their tax planning. Consider a manufacturer investing in new equipment. By using the 2026 40% first-year capital allowances, they can create a £100,000 paper loss to use in future years. Since April 2017, these carried-forward losses have become more flexible. They can now offset a company's total future profits, rather than being restricted to the same specific trade. A group has an annual £5 million deductions allowance. Profits exceeding that face a 50% restriction on loss relief. This allowance must be explicitly claimed in tax computations. If missing, the allowance is nil, and the restriction applies to every pound of profit. Aggressive investment via capital allowances will only provide a financial benefit if supported by meticulous, forward-looking tax compliance. Effective loss management requires selecting the right pillar for the situation. Prioritize immediate cash with a carryback, or mitigate future liabilities while navigating the £5 million cap. This HMRC manual details a final option for corporate groups. Provided you meet the 75% subsidiary rule shown here, one company can surrender its losses to a profitable sister company via group relief. This information covers general UK tax rules for 2026. Every business structure requires a specific analysis to ensure compliance and maximize relief. A corporate loss represents a strategic asset for businesses seeking to stabilize their cash flow. Contact Fairview Accounting Services to discuss your specific structure and optimize your position.